Well, welcome to this episode of Capital Decanted. I am delighted to be here in studio with a good friend of mine, Kai Wu, who is the founder and CIO of Sparkline Capital. Kai, welcome to the show.
Glad to be here.
Really excited to finally have you. I've known you for a long time. For those of you listeners that aren't familiar with Sparkline, they do amazing work. So just outside of this particular conversation, as I often say in public, I highly commend Kai's work. So check it out. Kai, I'm thrilled to spend some time unpacking this idea of where on the value chain is there value creation to be had in AI. And I think there's lots of historical lessons that perhaps are applicable in some ways and not applicable in other ways. And I think you're going to help us on that journey today. So I want to start maybe at the higher level, at just you're a student of hype cycles, of tech paradigm shifts. You've done a lot of work on this. And I first would like to just level set a little bit. As you look back at previous tech paradigm shifts, platform shifts, where do you think we are on that curve in the AI hype cycle? And why do you think that's the location currently?
Yeah, I mean that's a great question. I think the thing to remember is that history only rhymes, doesn't repeat exactly. But that being said, if you go back and study the history of technological revolutions, almost never do you see a situation where the technology diffuses through the economy, changes the world, and there is no hype, and there is no exuberance in at least certain pockets of the economy and the markets. So with that out of the way, I mean, I'd say there's kind of two almost parallel things happening right now. So first is what I call the build out. And that's the build out of the infrastructure required to run AI workloads. Think of AI data centers, the production of GPUs and other assorted components for the production of AI, as well as electricity and power and the physical components needed for data centers. Now, where are we in that part of the cycle? I'd say we're pretty advanced. I mean, we just saw this is being recorded at the start of May. We just saw the big tech companies, like hyperscalers report, and they've been guiding even higher with respect to capex. They're already spending hundreds of billions of dollars on AI capex, and that number seems to be set to increase such that the $1 trillion mark, the $2 trillion mark is not out of question over the next few years. So we're well underway with respect to where we are in the build out and construction of AI data centers. It's become, a big part of the discourse, politically, for example, folks are now starting to push back on the effect on electricity prices, and, to a large extent, the stocks of AI infrastructure companies, not just hyperscalers, but, across the chain, have run up in anticipation of the, $1 trillion+ of capex coming down the pike. So that's the first part of the story. The second part of the story is the adoption, the usage of AI, right? Because you can end up with a scenario where we build a lot of supply, but there's no demand. And that's, of course, what has happened in the past that has led to, a lot of the, issues for investors. So where are we on the demand side? And I think that's an interesting story. I guess the high level stat I would begin with is, when the, BLS, the U.S. government, surveys businesses, they find that about only 10% of companies report the use of AI in production. In production being, I mean, depends on what industry you're in, but actually using it to produce goods and services, which is a rather low number, but, doesn't feel so off. Right? I think one of the things to think about is, when a lot of these AI luminaries go on, podcasts or, talk about the diffusion of technology, they're like, oh yeah, we'll get diffusion in like 1 to 3 years. And I feel like that's wildly over optimistic and to some extent reflects like the bubble that, Silicon Valley is in. If you work at a real company, like a large enterprise, say Fortune 500 company, that it takes a long time for technology, even traditional, software to diffuse. So I think we're still pretty early in that part. Obviously we have seen, data coming out of Anthropic and OpenAI showing that their revenues have increased exponentially, especially over the past 6 months since Claude Code and Codex have come out. Right. So on the demand side, there were basically two big moments. So the first was the ChatGPT moment when ordinary people discovery that, oh wow, this AI stuff's kind of cool. I can ask it for like recipes for cooking and such. And then the second one was towards the end of last year, let's call it November, when Claude Code got really good, and software engineering had a paradigm shift with respect to how folks, including myself, by the way, go about coding using agents now, and that I think drove a lot of demand. So we're seeing that explode. I think the one thing to be cautious of is you often hear stories of, oh wow, we're like at capacity, the servers are going down because we don't have enough supply to run all the stuff. But of course, like that all just depends on the price, right? Because at some price, you set the price low enough, you're always going to have unlimited demand relative to supply. If I have $1 Ubers, for example, then I'm going to be taking the Uber rides all the time. And to some extent, these companies are running the classic internet consumer era playbook, where they're subsidizing demand via artificially low token prices, and thereby they will of course always have this situation where there's a backlog of interest relative to capacity. So I think that's like just a useful thing to keep in mind as as a way of cautioning not to read too much into the signals that are coming out of these labs. That being said, I mean, I think the demand is real. The question is kind of down the line, how sustainable is that? Obviously, there's a lot of hype around AI. A lot of AI startups are kind of being founded. Most will fail, as has always been the case around the use of AI. And then large companies are now doing a lot of pilots trying to incorporate AI. But we still don't know to what extent that will be sustainable in the long run. Like these companies may start doing these pilots and decide, what, like that was interesting, but like I don't see where the ROI ultimately will be. So let's just kind of wind that down and kind of move forward with our lives. So I think we're still pretty early on the demand side, and supply is coming pretty much no matter what. Obviously, these are multi-year projects, and a lot of them have already been kicked off. So that's coming no matter what.
So I think this decoupling of supply demand is one of the oldest stories in tech paradigm shifts, and it really is the hinge point, right? And so let's cycle through kind of both of those elements, and let's zoom in first to the capex, the supply that's going on. You've spent some time studying this, so the obvious corollary of what's happening now with compute is the fiber optic race that we saw earlier. This underlying infrastructure that laying rails effectively always precedes adoption. It has to. So can you give us a sense of how we should kind of size the spend of the LLMs and the hyperscalers in comparison to the fiber optic CapEx layout in the 90s? How do you kind of do an apples and apples economic impact comparison across, two paradigm shifts that are separated by almost 30 years?
Yeah. Well, so just in absolute dollar terms, obviously the current build out is significantly higher than in the late 90s and early 2000s with respect to the fiber optic cables that were underpinning, of course, the internet. So that's one data point. Perhaps you'd want to adjust for GDP. So how big is the spending relative to the size of the economy? And even there, you're higher. Slightly higher than the fiber optic build out as of say last year. And again, these companies are guiding higher. I think the expectation is that peak spending will only increase year on year for the foreseeable future. And then the third thing you can look at is adjusting it for depreciation, right? So if you go back even further, 100 years beforehand, we saw the build out of the transcontinental railroads in the U.S. That was a huge expense. Railroad companies were a huge share of the stock market at the time. Hundreds of companies, sprouted up to take advantage of this opportunity, which at the time was, the biggest paradigm shift. And as a share of GDP, spending was actually even higher than we are now. But here's the thing: when the bust came for the railroads and all these companies went bankrupt, the thing is that railroads last basically decades. Obviously with some minor repairs, but once you lay the steel, it's a pretty robust technology. And fiber somewhere in the middle as well. The challenge with AI data centers is that over half the cost comes from GPUs, and GPUs have a useful life of, let's say, 5 years, plus or minus. I think the hyperscalers generally estimate something around there. Some have argued that it's less, others have argued that it's slightly more. But the thing is that, look, with AI technology accelerating as it has, what that means is that say if NVIDIA releases a new chip each year. What that means is that if each year your GPU fleet is now obsolete, you're now below the cutting edge. right? And so there's a risk of obsolescence to the extent that companies invest heavily in AI data centers, and then say in a few years, their chips are so far from the frontier that they are no longer worth utilizing, say, given the amount of power consumption and such, if that's the bottleneck. Um, so when you adjust for that, then the build out makes it seem like the build out's even more extreme and unprecedented in the US history. So
Mm.
yes, basically my long winded answer is yes. It's a big deal. It's moving the economy. It's moving the stock market. Pretty much the biggest driver of the economy and stock market over the past few years has been this singular race to build out AI.
So as you articulated well there, Kai, there's a lot of rhyming, to use your word, from not just the fiber optic build out, but perhaps even the railways, but at a size that's even on adjustment basis is even bigger, you could argue. The problem with the fiber optics were twofold that you've alluded to. One is they preceded the demand by several years. Now, you and I obviously knew that 5 to 8 years later, all that fiber optic cable was being used and there were new businesses created and amazing innovation for mankind. So it was a very good thing. But those companies that laid it, I still have scars from the WorldComs and the Level 3s, right? And they were bankrupt. They were operating under assumption of complete lack of equilibrium on supply demand with a very fragile balance sheet. And there's some big differences, at least as I can tell. I hear these anecdotes that compute is reserved out till 2029, that there's all this demand coming in. So they're building these data centers, this compute for real demand. It's not that they're hoping like we did in the fiber optics. That maybe the even bigger difference is that these balance sheets of these huge, the Magnificent Seven in particular, are still fortresses. They are massive. This is not a WorldCom situation. So the other side of the equation is you perhaps have builders here that can weather the storm of demand catching up for much longer. Would you agree with those statements?
Yeah, so I think there's two parts of that question. So first is, what is the timeline of demand, right? If it shows up tomorrow, or will it show up in 10 years, which is great, but maybe the builders don't make it to the other side. And then the second part of the question is, of course, how do their balance sheets look like? Maybe they have the ability to withstand 10, 20 years waiting for the J curve, in which case it's a lot different from what happened in the dot-com boom. So for the first part, I think it two things. So first is just what I said earlier around subsidized demand. Some of the demand is artificial, I'd assume. So when people point to the fact that there's a big backlog, I mean, yeah, of course, that's almost by definition. It doesn't tell us as much as we would wish around what is the true demand as opposed to subsidized demand for AI workloads. And second is this question around I think the efficiency of AI workloads, right? And if you go back even just a few years, the way that AI has been used has changed dramatically. In the very beginning, all the AI workloads were predominantly on the training side. Each company was racing to build a bigger model, but people weren't really using it on a relative basis. Then what happened was there was a shift towards, well, I guess this happened in parallel, but there's a shift towards, more of the workloads being done at runtime, right? So this is like the kind of reasoning models whereby if you sit there and are more patient and allow the query to do more things at runtime, you get a better response. You get more intelligence, let's call it. So then more token consumption shifted from training to inference, which inference being like the kind of runtime usage as opposed to the kind of upfront investment required to build models. And yes, the second thing that's happening is just a increase in the amount of usage of AI post training in general, right? And so that's just the fact that these models now exist and they're pretty good. And so yes, we're going to be continuing to get better models, but relative to the fact that companies are now actually starting to use these technologies and consumers as well a lot more, that's also shifting the mix. And by the way, that has implications, and this isn't part of your question, but that has implications a little bit for companies like NVIDIA, who have more of a moat when it comes to training than inference, right? So we have now TPUs and Trainium and a bunch of startups as well trying to capture NVIDIA's margin, So that's an important component that's happened. Now, and the second thing that's happening, of course, is around. So the second part of your question is around the balance sheets of these companies, and I think it's pretty obvious that the firms who are investing in the build out are your kind of magnificent seven companies, your hyperscalers, the most successful companies of our generation. And these firms have, tremendous earnings power. They've done extremely well. And, entering the cycle, they had pristine balance sheets. What you're now seeing, unfortunately, is that their cash flows are eroding, that these companies are, so excited about AI that they're spending more and more money on it, such that, companies like Amazon, which reported last week, I mean, their free cash flow is down 95%, basically approaching zero. And so these companies, they used to pay out and do buybacks and pay out dividends or whatever to shareholders. That's not happening anymore. In fact, arguably they're even cutting employees in order to make more room in their budget for doing this. And then you see some of these firms starting to raise debt. And then, obviously Meta is kind of the most famous example, doing kind of some SPVs in order to do this kind of all balance sheet. So, I think that was true going into the cycle. We'll see where we are at the end. Even firms of this size will struggle to pay for this build out solely out of, organic cash flows. So, but that being said, I do agree with your overall premise that unlike in the railroads, especially where these companies were highly levered, kind of speculative stocks, and there were hundreds of them, or in the dot-com boom, where yes, you had AT&T, which is of course an established company and a monopoly basically, but you also had guys like Global Crossing, which were far more speculative. So you had a bit of a mix there. I mean, I guess in this case you have that too. You have CoreWeave and some of these neoclouds, which are kind of more in the Global Crossing category, and I could see if there is stress in the system, folks like that being in significant trouble. I find it hard to imagine of, Microsoft or Google, like, even in a dire scenario for AI, having true balance sheet issues. That being said, like as an investor in these companies, you do need to remember that, all right, well, they're funding a massive amount of money into this other segment of their business. And so, if there is an issue there, at best, it's just diluting the quality of your investment. So you're saying, all right, well, I invested in X and X is great and Y is just okay. So, maybe it's no longer magnificent. And I think that matters a lot because, right, these Magnificent Seven stocks, they basically carry the stock market over the past 15 years. I want to say that they created $23 trillion of wealth for shareholders with returns far in excess of the market. And thereby, the fact that the U.S. stock market has outperformed the internationals and small caps largely on the back of these companies. And by the way, like their success has been driven by their kind of asset-light business models, right? The fact that they've employed intangible assets like IP, brand, network effects in order to earn really, really high ROIs without much capital invested. And their business models are changing dramatically now, shifting from asset light to asset heavy, where they're now doing a ton of CapEx, right? And we've studied this. We know that the companies that are asset intensive have historically been worse businesses, right? This is well studied within the academic literature. Companies that invest aggressively into the capital cycle have tended to underperform. So, that does not bode well for these firms, which are such flag bearers for the stock market. And by the way, due to their success, have become a huge part of the index. So the S&P 500, right, is 33% of the index is Magnificent Seven stocks. And that's just by construction, right? Because the S&P 500 is market cap weighted, which means that bigger stocks get bigger weights, and it embeds a momentum strategy where the better a stock has done, the more weight it gets. And so I think to some extent, like it's going to always have the most weight in a sector at kind of as it's done well. Right. And this didn't work well in the dot-com boom. In the dot-com boom, the IT services sector went from being a small percentage to a huge percentage as those stocks became more and more, became larger and internet hype built, and such that the index was max weight IT right at the bust. Right. So there is some kind of risk there, concentration risk. And then, by the way, if you add in like other AI infrastructure names like Oracle and Broadcom, you get to a number even higher. So it's not 33% of the index, it's like 50% of the index is tied to the single trade, which is AI infrastructure, build out being successful. So I mean, I think it matters, we have a lot riding on this being successful. Yes, these firms have the balance sheet to weather, a lot of what could happen. But we really don't have great visibility into the sustainability of demand, the currently high demand, as we kind of move into the future.
I just want to underscore what Kai said there because I don't want listeners to miss it. You've done a ton of research even outside of AI on this idea of intangible assets and the implications it has on valuation. So just to make this very simple in the way that I've studied your research, if a company buys a piece of equipment for a factory, right? Accounting rules require you to depreciate that right through the P&L over a course of a number of years. If you are an asset light business that has intangible assets, it's expensed immediately. So the argument to get back to apples and apples is that actually, ironically, some of these asset light, high tech, innovative IP companies could be understating their earnings power, and therefore their multiples arguably should be even higher. Now, as you just said, which is really the key point here, they're shifting away from this asset light to this asset heavy business. Return on capital, return on investment, perhaps multiple contraction. All of that, I think, is also up in the air too. So I think that's just a really important point as you think about the weight of the Magnificent Seven in both how much they've supported and carried the U.S. stock market in particular, and also the economy. So really important point. I want to shift, Kai, to the question at hand as we've set the context here for what's happening with this paradigm shift. And that is, where on this value chain, what segmentation, what part of the taxonomy is going to capture this value? So in some of your reports, you've used a segmentation of infrastructure, digital natives, and fast followers. I don't know if that's the best way to approach where on the stack and maybe the supply chain you think value will be created for investors. But how would you kind of segment this before we get to where do you find the most attraction? How would you segment this kind of industry shift?
Yeah, I think the way one could lay out, and there's obviously infinitely granular ways to divide up the AI value chain, but broadly speaking, you have the power suppliers, and then the data center chip makers, data center operators, and then model providers. Those four levels you could kind of broadly put into the category of infrastructure. And then beyond that, there's like the users of the technology. Okay, great. I'm sitting here as a fund manager, and I can access the models that OpenAI and Anthropic say and Gemini they build on the back of all that hardware, but I'm just using the API, let's say, so I don't need to worry about I can abstract away from exactly how that's done on the back end. So I'm a user. Of course, there are users in all industries. So I'm in the financial services industry. There are others in, say, industrials and healthcare, like doing drug discovery. Across the economy, obviously, software is a big, category that has sold off on the back of AI disruption fears, which we can talk about too. But there's all these different segments. I'd say you could just lump everyone, just for simplicity, into users or adopters. A better way of looking at things, I think, is rather than looking at it like by vertical, by industry, to instead say, like, where is each company or each industry on this kind of S curve of diffusion, right? So the classic diffusion model is there's the kind of early adopters, and there's the kind of the late adopters, and then there's the laggards. This kind of S curve through time. As I mentioned right off the bat, the on the demand side, we're at around 10% of businesses are using AI in production. So that gives you a sense of kind of where we are on that curve. What's quite interesting is that within each industry, there's massive dispersion, right, between leaders and laggards with respect to AI. Like pick a given industry, financials, healthcare, industrials, there's always going to be a handful of companies that are really aggressively pursuing the opportunity, investing heavily in incorporating AI and experimenting with AI. And then there's going to be like 80% plus that are just doing nothing, right? And so there's huge separation between these two components. And so I think a useful part of the taxonomy would be to say we have early adopters on one end and then like laggards on the other. So that gives us now three buckets. We have AI infrastructure, early adopters, and laggards. I think that gives you a relatively clean taxonomy of firms in this category.
Okay, so as I push you a bit more on where the value creation comes from, again, with the benefit of rhyming of history of what happened with the fiber optics and the infrastructure side of the business, completely commoditizing, or worse, you could argue. You're managing the Wu family office, as an example. You're an allocator. You've got complete flexibility to invest up and down the chain, infrastructure, early, late, any application in any particular vertical. What use cases are you most excited about that will have durable extraction of value in this transition?
Yeah, so I think the first lesson of history, since that's what you referenced, is that basically every time I've looked at a paradigm shift in technology, whether it's the internet, the railroads, electricity, etc., one common theme emerges, which is that ironically, the builders of the infrastructure are not the long-term winners. In fact, it's actually the users of the technology, the adopters. So, for example, in the dot-com boom, all the telecom companies that were the hottest thing in the 90s, they spent all this money, all this capex building out fiber cables. They, had a lot of trouble. Many went bankrupt. Others just, were dead money for years. So the telecom index skyrocketed in the late 90s and then went down 92% and still hasn't recovered. Right. So that gives you a sense of how those guys did. And, we know the story. It's like the traditional, it's like the classic capital cycle where these firms invest a ton on the supply side. Demand takes too long to materialize. The ones that are levered, then the prices fall, of course, because of supply and demand for bandwidth. It goes down, 85%. We have all this dark fiber. No one's using it. And that means, of course, that the levered companies go bankrupt, and then the ones with better balance sheets, they survive, but they struggle for a long time. They have impaired assets. And then what happens is along comes Google, which wasn't even public, before then, Meta, Netflix, and these companies say, wait, this is amazing. We have all this subsidized bandwidth. Let's go build the internet business. And then they go out and crush it. So in the case of the internet era, we know what happened, which was that the builders, the telecom companies, failed. They didn't capture any of the value that was created by the internet. And it was the users, the application layer, that captured all the value and then became effectively monopoly companies on the back of the internet. And again, the same thing happened in the past. So, I think that's useful perspective to start with because, from where we stand now, we've now lived through the first phase of the AI build out, the AI boom, which is the build out phase, where we've seen all this money pour into capex, all the profits like flow to NVIDIA and to some of the data center operators and some of the power companies, and that's been great for investors in that part of the stack. But the thing is that if you zoom out, never in history has that been the kind of static equilibrium, right? Always in history, those utilities have struggled to, maintain profits while the applications have captured all the value. Now, I'm not saying that necessarily we'll have the exact same outcome, but it's important to think about that, especially given how the stock prices of these companies have run up so much on the back of their prior success. And again, they're now big parts of the index, which drives passive flows into it. So there's a lot of dynamics here that kind of create this momentum effect. And I think people have a harder time imagining, how could this play out differently such that these firms, are the ones that do not actually capture value. I can give you a few examples there. I mean, I gave you the example of NVIDIA already. They've so far had a kind of monopoly position with like the CUDA software development component, building network effects around what they do. But because the workloads are shifting from training to inference, their moat kind of is no longer as powerful there. And a lot of their biggest competitors, Amazon, Google, are now competing against them as well as other startups, right? Like whenever you see, your margin is my opportunity, right? The capitalism is pretty efficient. They see big profit margins and they try to compete it down. On the model side, kind of the same things happened where, remember when ChatGPT first came out, the underlying model was GPT 3.5. That thing was, 1 to 2 orders of magnitude more powerful than the next best model. Fast forward to today, OpenAI doesn't have a monopoly. In fact, by some measures, they're behind. But you at least have at least 2 other competitors, Anthropic's Claude and Google's Gemini on the frontier, as well as you have the open source Chinese models, which are not only open source, but also more compute efficient, nipping at their heels. So not quite as good, but a lot cheaper, in fact, free, and also open weight, so a lot more transparent, right? So that's an argument for saying, hey, maybe we're at risk of the model companies actually being commoditized. What would happen if that were the case, right? That's basically what Apple's betting on, right? So Apple's more or less abstained from the AI arms race. There's this whole game theory thing going on right now where, the optimal thing for each of the Mag 7 would be for them to kind of get together and say, let's invest in AI, but do it at a moderate pace. They've been in this cozy oligopoly where you basically take up the universe of digital services, divide it up into like shopping, social media, search, and each one of them kind of owns one. And that's been a great scenario for them from a market structure standpoint. The problem is that all these guys believe, whether correctly or not, that AI is collapsing all markets into one. And so that he who wins AI wins all the markets. And that's created this existential dread, I guess, or FOMO, such that these companies are now basically betting everything on AI. Right? You have like, the CEO of Google being like, yeah, I'd rather go bankrupt than lose this race. So now we're in this kind of like the defect quadrant of the prisoner's dilemma, where each firm is like, all right, well, if everyone else is cool being moderate, that's fine. But as soon as Sam Altman goes all in, they can't afford to not also go all in. And so that, I think, really increases the risk of a potential overbuild, which again is what we've seen in every historical episode, which of course would be not so good for the infrastructure layer, but would benefit as a subsidy to the users of these tools. So I'd say like that to me suggests that, again, like there's a lot of micro components. Like there's aspects of the infrastructure layer that we've invested in, that we continue to invest in. But on a macro level, what's happened is that since our strategies have been kind of more overweight into AI infrastructure even a few years ago, and as the boom has kind of continued in that space, has generally reduced its overall allocation to infrastructure stocks, and then in exchange has invested into more of the AI early adopters. So one of the interesting things there that I think is really worth mentioning is valuations. Right? Whenever you go through a technological boom, value is a really important indicator, because if you don't have value awareness, when do you know to sell Cisco before the crash in the dot-com boom? You need some sort of value to help you rotate through this, because as I mentioned, like these are dynamic scenarios where companies are being created and others are and rarely is the first mover the one who wins ultimately. So you need to have some kind of ability to rotate. How do you do that? What I've from all the things I've looked at, the best indicator is valuations, to kind of like find innovative companies up front, but as they kind of get rich, to sell out of that and go into the next phase. What we've seen is on the infrastructure side is not only is there huge capex risk, but there's some valuation risk now in play too, where these stocks have just done so well, and whenever companies like Oracle or whatever announce new deals to spend, they've historically been rewarded by stock prices. Now, what's really interesting is over the past few months, that's shifted, where we no longer see that premium for further investment into capex. Right, so Meta is a good example. They've been investing probably the most aggressively of all the Mag 7 into AI, not only as a percentage of their sales. I think it was 33% as of last year, and it's approaching 50% now of sales are being spent on capex. So that puts them the most aggressive on a relative basis to their size, and then also the fact that they don't have a public cloud, right? So they're putting they're buying all these GPUs for their own internal usage. They don't have an outlet in case they over build, and so their stock's down, right? Even though they had a decent quarter. So I think the market's starting to shift its narrative a little bit, starting to recognize some of the risks of capex and the valuation and kind of things embedded in these companies. So where would you go instead then? Then the only other place to go if you want to be long AI is on the early adopters, right? And there, what's something interesting we're seeing is that the market's not like pricing early adopters and laggards differently. So if you take say financials and look at the firms that are really aggressively investing in AI and those that are just doing nothing, they're trading more or less at parity on like a PE or whatever multiples of choice you look at. So I think that creates an opportunity where you can kind of get I guess, a free call option on AI by focusing on that. Because, there's basically two states of the world. Either AI becomes transformative, which I believe, and I think many people do believe, in which case you'd have to assume that not only would NVIDIA and the AI infrastructure companies do well, but so would the users, right? Because you can't end up with a scenario where NVIDIA does well in the very, very long run if there's no one buying the AI services. So they kind of go up and down together, or AI is a bust, in which case, NVIDIA goes down big. But in that state of the world, the nice thing is that relative to, say, the laggards, if AI is a bust, yeah, okay, that's not ideal for the, say the bank that invested, a few $100 million in AI, but at least they're not spending billions of dollars, right? So the downside is not as significant, both from a capex and from a valuation side of investing in the early adopters. So I kind of feel like that middle category is a nice way of playing the second order beneficiaries, where you get a lot of the upside in the event that AI is truly transformative, but without a lot of the risks of just kind of going in on the most obvious pure plays.
Yeah, yeah. Question just as we close here, Kai. In between the model builders, the infrastructure, as you called it, and perhaps the risk of commoditization on the front end there, and the other side, which is the kind of consumer benefit or the average operating company being able to apply this and and improve margins as a result of efficiency and labor cost diffusion, is what I would call maybe an application layer for the users that are either vertically based, like a Harvey on the law side, or tools for eventual users to kind of apply this stuff to their enterprise. So Palantir or a Cursor, right? Where would you put that category, if that's an appropriate way to frame it, Kai, in this kind of investability? Do those have durability to kind of exist? Will they be bought by the big model companies to move downstream? Where do you see that going?
Yeah, I mean that's a really good question. So let's take Harvey as an example. They're basically doing AI kind of in a specific vertical, which is law in this case. Now the risk is pretty obvious that Anthropic and OpenAI say, hey, why don't I just do that myself? I can just do that. Like, I was reading that there's like, ChatGPT for doctors is kind of competing against Open Evidence, and Anthropic's creating all these financial, like, I guess plugins or whatever, Anthropic for finance, Cloud for finance, which compete against the kind of finance specific verticals. Right. So, I mean, you can look at it both ways. I mean, I think it remains to be seen how that plays out. And you're totally right that there could be a scenario where maybe the idea of Harvey existing as a standalone company is not a long-term sustainable thing, but they just get acquired. But there's also competitors to Harvey. There's a lot of, these law tech companies spreading out. So it's not even clear there how that goes. I think it's a perilous position. I mean, I would definitely be, you know, concerned. I mean, that would be the main threat there. Then there's a second layer. You mentioned like Cursor, which, and then there's Perplexity as well. What were once kind of derided as AI, like GPT wrapper or LLM wrapper companies. I actually think that has more staying power than one might think, right? Because the reason why folks always were kind of pessimistic about those companies, they're like, oh well, like you're just a wrapper around GPT. So then OpenAI is just going to, disintermediate you at some point, right? In the same way we just discussed with law. I don't know about that because like, I think increasingly what's happening is that the underlying intelligence is becoming commoditized, right? So, imagine I'm sitting here and I have the ability to toggle from Claude to GPT to a Chinese open source model. And I can just kind of pick which one I want. At that point, like there's not much differentiation there. So ultimately, then who owns the value is who owns the customer. And in that case, like the wrapper company might own the customer, right? So Perplexity, I mean, I'm not a big user of Perplexity, but I know people do use them. And from there, you can just kind of toggle models, right? And so they're now making a play to capture that. And what's interesting is I think that the sustainability of that piece, where maybe you could capture some moat there, I think is actually becoming more. Is being validated by the model companies themselves. So one of the big things that firms like Anthropic have done is they started to kind of move up the stack, so to speak. They're building out like Claude Code, and we have Codex as well, Claude Cowork. And what these products basically are wrappers around the underlying models. And what they're trying to do is bundle. This is the classic Microsoft strategy, right? To bundle their raw underlying models, which are still the best, with the harness, the middle layer, right? And the best example would be, OpenClaw, right, which is an open source, framework for running AI agents. OpenAI basically didn't quite acquire them, but kind of acquired them. And then Anthropic at some point said, look, like, why are we allowing this on our platform? And then they kind of like, downgraded them, I guess, in their, they said, you guys can't really use this anymore, right? We much prefer you to use Cowork or Claude Code, our own kind of harnesses, right? So these companies are trying to kind of vertically integrate across that stack, which suggests to me that they are also recognizing that, maybe the moat's more kind of upstream to the application layer, as you point out. So I think that's a really good question. And I think it's kind of the multi-billion, maybe $1 trillion question, which is like, is there a sustainable moat for the vertical applications and or like that middle layer? And I'd say, it's jury's still out on that. And that, I think it'll largely come down to a lot of, case by case scenarios. But that is, if I were, more focused on the private markets, which I'm not because I'm a public market investor, that would be, those would be the questions that I'd be asking.
Yeah, I think what's interesting is unlike the infrastructure builders, the fiber optic manufacturers back, 30 years ago, the hyperscalers and the builders now have a long history of very successful consumer application capability. Facebook, Google, OpenAI more recently, these organizations understand the consumer. They know how to monetize consumer applications. So it will be interesting, especially with a more healthy balance sheet. Although, as you said, free cash flow has certainly dried up quite a bit. But nonetheless, with a healthier balance sheet, with a real affinity and pedigree in consumer applications, will these infrastructure players even allow that middleware segment to kind of form without their participation? So I think this is something to watch. I think it will have a different flavor to it than I think as a result of all that we've talked about than previous cycles. So listeners, we're going to have to leave it there. Kai, it is always a pleasure to see you. I always learn so much by either reading or talking to you. I'm grateful you came on, and we will see you next time on Capital Decanted.